All right, let's talk about something that sounds super complicated but doesn't have to be. German taxes. I know. It can feel like a total mystery. But today, we're going to pull back the curtain and make it all make sense. Have you ever looked at a German payslip and just felt your head spin? Like, where did all my money go? Trust me, you are not the only one. It's a pretty complex system, but it's got a logic to it, and we're going to crack it.
So, to make this really easy to follow, we're not just going to throw rules at you. We're going to follow the story of Julia. She's a developer who just got her first job in Berlin, and we'll see exactly how her taxes change as her life changes.
Okay, first things first. Your paycheck. What actually happens between the salary your company offers you and the money that lands in your bank account? Let's break it down using Julia's first salary. So Julia is earning a gross salary of 50,000 euros. Awesome. But right off the top, two big chunks are taken out. You've got about 10,250 for Social Security and then another 7,000 for income tax. What's left, her take-home pay, is around 32,750. Understanding these two deductions is really the first big step. So how is that income tax figured out? Well, Germany uses what's called a progressive system. It's just a fancy way of saying the more you earn, the higher your tax rate gets. The first chunk of your income, just over 11,000 euros, is totally tax-free. Nice. After that, the rate kicks in at 14% and climbs. The key thing to remember is you're not paying that top rate on your whole salary, just on the part that falls into each bracket. And that other big piece, Social Security, it's not just one thing. It actually covers all the important stuff: your state pension, health insurance, unemployment insurance, and even long-term nursing care. And the best part? Your employer pays half of it, and it's all deducted automatically. Okay, so that's life as a single person. But life changes, right? And when it does, your taxes change too. For Julia, the next big step is getting married. And in Germany, this has a huge impact on your finances. So Julia meets Matthew. As soon as they tie the knot, the tax office stops seeing them as two separate people. Now they're seen as one economic team, and this unlocks a whole new set of options for them. Once they're married, they get to choose their tax classes, or Steuerklassen. Think of it like picking a financial strategy. If Julia and Matthew make about the same amount of money, they'd probably both go for Class 4. It keeps things simple and balanced. But if one of them earns way more than the other, they can use this really powerful combo of Class 3 and 5. This gives the higher earner a massive tax break every month, which means more cash in their pocket right away.
The secret sauce behind this is a German concept called Ehegatten splitting. It's basically income splitting. The system pretends they both earn the average of their combined salaries. So if Matthew's a high earner and Julia isn't, this little trick pulls his income down into a much lower tax bracket. It's a real game changer.
And what does that actually look like in real money? Well, let's say Matthew earns 60,000 euros and Julia isn't working. Just by filing their taxes together, they'd save around 3,500 euros a year compared to if Matthew were single. That's a pretty sweet deal. So now, Julia and Matthew are a financial team. What's next? Well, starting a family. And this is another area where the German system really kicks in with some serious financial support and tax breaks for parents. The most direct and frankly awesome benefit is called Kindergeld. It's simple. For every kid you have, the government sends you 250 euros. Every single month. It just shows up in your bank account. So with 2 kids, that's 500 euros a month, tax-free. Wow. But that's not all. There's also a big tax-free allowance for each child, the Kinderfreibetrag. It's worth over 9,000 euros. And here's the coolest part. You don't have to choose between this and the Kindergeld. The tax office automatically figures out which option saves you more money and just gives you the better deal. How great is that? And if Julia and Matthew use childcare, like a kita, they get even more back. They can deduct 2/3 of what they paid, up to 4,000 euros per kid, from their taxable income. This means they get a nice refund on those childcare costs, making it way more affordable. And the system also has support built in for other difficult life situations. For example, if someone in the family has a certified disability, they can get a fixed annual deduction. This just lowers their taxable income, providing a bit of extra financial breathing room when they need it most. So the family is growing, and Julia and Matthew are starting to think more about the future. It's time to start investing. So how does Germany tax the money you make from your money? Well, this is completely different from your salary. Profits you make from investments, like selling stocks or ETFs, get taxed at a simple, flat rate. It comes out to 26.375% on any profit you make. It's straightforward and totally separate from your income tax. But you get a tax-free head start. You don't pay tax on every last euro of profit. As a single person, your first 1,000 euros in profit each year is completely tax-free. And since Julia and Matthew are married, that allowance doubles to 2,000 euros. Okay, but let's be real. Investing isn't always about winning. What happens if you lose money on a stock? Well, here's where the German system is actually super helpful. A loss isn't just a loss. Think of it as a tax discount you can use later. Let me show you how this works. Say in 2025, Julia sells a stock and takes a 3,000 euro loss. The tax office keeps a record of that. The very next year, she has a good one and makes a 4,000 euro profit. Now, instead of paying tax on the full 4 grand, that loss from last year gets carried forward to cancel out most of the gain. She only ends up paying tax on 1,000 euros of profit. And those losses, they can be carried forward forever until you use them up. So we followed Julia and Matthew's journey, right? From her first job to getting married, starting a family, and even investing. Let's just zoom out for a second and look at the big picture, including retirement, to see how it all fits together. This table really puts it all into perspective. Remember Julia as a single person? Her 50K salary went about 32,750 in her pocket. When married with a 60K income, that jumps to over 40,000. Add 2 kids, and with Kindergeld, their family benefit is over 46,000. And then there's retirement. A big chunk of your state pension is taxed. So for someone retiring in 2025 with a 25,000 euro pension, they pay tax on about 85% of that, leaving them with roughly 22,000. See, every stage of life has a different part of the system ready to support you. So in the end, the German tax system isn't some scary monster you have to fight. It's really more like a roadmap that changes as your life's journey changes. It's built to support you, whether you're single, married, raising a family, or planning for your future. The real question is, now that you have the map, how are you going to navigate your own financial journey? For more simplified finance in Germany, make sure to follow along.